Did you know if you pass up a 4% employer match in an employer-sponsored retirement plan on a $50,000 annual income over the course of 30 years at a 10% rate of return, you'd miss out on $360,000 in investment gains. Also, if you held that $360,000 in an account that had just 1% higher expenses or taxes or some other rate of return reduction, it would cost you over $60,000 in that amount of time. Clearly, where you save your money matters. In the United States, we have a variety of tax-advantaged options available. As I was preparing for this video, over a dozen came to mind, and I'm not even wading into the Roth versus traditional debate. You've got 401ks, 403bs, 457s, thrift savings plans. Those are all available through sponsors. You've got a plethora of IRA types, and in addition to that, you may also have access to a health savings account, which can be used as a secondary retirement account once you turn age 65. In all likelihood, you have access to a variety of retirement account options, and it's kind of like being dealt a hand of cards in a game. You don't have any control over what you get, but there's certainly a wise way to play the hand you're dealt. Now, obviously, we can't provide a specific answer on which strategy is best for you, but we can walk through several common scenarios and see how someone might prioritize these different account types to produce the greatest long-term benefit. Now, I want to give a few disclaimers before we walk through this. First, none of this is financial advice. This is a video. It's for information only. Nothing in this is recommended for you specifically. If you have any questions, you should reach out to a financial professional for advice. The second thing is we're not going to wade into the Roth versus traditional debate. We have another video about that, which you can follow in the link above. I'll put one in the description below as well. Most of the account types we're actually going to talk about are available as either a Roth or a traditional option, but in the interest of time, we're going to leave that out. We're also not going to include college savings in this list at all, so 529 plans, ESAs, things like that won't be on this list. Finally, this is not an exhaustive list. We're only going to refer to the most common tax-advantaged retirement account types. There are some others out there that we won't speak to. Sorry, we just don't have time to cover everything. Just know that if you have access to a less common retirement account type, you'll need to look into that on your own. We've listed these in order of their potential to you as an investor, but as you'll see, the best options depend on your personal circumstances. All right, number one is anything with an employer match. Now, an employer match is not a retirement account, but an employer match is the most valuable wealth building tool commonly available today, and they're overwhelmingly available in retirement accounts. Around 98% of employers who offer access to a 401k plan offer some sort of match, and 65% of those offer matches on a dollar-for-dollar basis. And in case you're wondering, the average maximum match value comes out to 4.16667% in the United States. Now, matching is most commonly found with 401ks, but it's also available through 403 plans, 457s, thrift savings plans, and also some HSAs. Now, any option in an account that has an employer match is going to be more valuable than any other account that doesn't have that option. This is also true probably in the case of profit-sharing accounts where it's not a dollar-for-dollar match. Even if it's only 10 or 15%, it's still free money, and you should take advantage of that. I also want to point out that just because the employer match is at the top of our list, it doesn't mean you should put all of your savings into that account. Instead, we suggest saving up to the maximum amount of your employer match. So if your employer only contributes up to 4% of your income each year into a retirement plan, contribute 4% and then move on to the next account type in our list. Number two is health savings accounts. So if you don't have access to an account with an employer match, but you do have access to an HSA, we recommend going there next. And the reason is HSAs enjoy triple tax advantage saving. What that means is any contributions, earnings, and withdrawals in an HSA are completely tax-free as long as they're used for a qualified medical expense. And if you make contributions through payroll deduction, you also avoid Social Security and Medicare tax, which represents 7.65%. And unlike HSAs, other employer-sponsored retirement plans don't get the benefit of avoiding Social Security and Medicare tax. Now, you'll note that I said contributions, earnings, and withdrawals are tax-free as long as they're used for qualified medical expense. But once you turn age 65, you can use the funds in your HSA for anything completely penalty-free, though you will owe income tax on any distributions you take from the account that aren't used for medical expenses. In this way, they're just like any kind of traditional retirement plan, be it a 401k or IRA, because the contributions and the earnings have been tax-deferred, and when you take the money out in retirement, you pay income tax on the distribution. So with an HSA, you get a lot of upside for medical expenses without really losing any of the benefits of a traditional retirement account. Now, HSAs do have annual contribution limits, which we've listed for you on your screen. You also must be enrolled in a high deductible health plan in order to contribute to an HSA. And one final word of caution regarding HSAs, any balances you leave to heirs will become taxable to those recipients or beneficiaries in the year that they inherit the account. Other retirement accounts give the beneficiaries up to 10 years to pull the money out of the account so they can spread the tax impact of that over a decade, but you don't get that benefit with an HSA. Option number 3 is 457 retirement plans. All right, once you've exhausted the employer match and you filled up your HSA, 457s are next on our list. 457s are normally available through government entities or nonprofits. You'll frequently see them in first responder type jobs, EMTs, firemen, policemen, things like that. And 457s are primarily governed by the same section of the tax code that manages 401ks, 403bs, and thrift savings plans. But the key difference is that a 457, you can make withdrawals from the account as soon as you retire. In other tax advantage retirement accounts, you have to wait until age 59 and a half to begin making penalty-free withdrawals. So in this way, 457s provide a lot of flexibility for early retirement that 401ks, 403bs, thrift savings plans, IRAs, none of those provide. This means if you save well, you're not penalized for retiring early, which makes them number 3 on our list. Number 4 is individual retirement accounts, or IRAs. So for the most part, we've ignored IRAs up to this point because there are no matching options available in IRA except maybe a simple IRA. But the one thing IRAs do have to offer is exceptional investment flexibility. With an IRA, you have an option of choosing your account custodian, which means you're also effectively choosing the investments you'll have access to once you open the account. In an employer-sponsored plan like a 401k or 403b, you're kind of limited to whatever assets the plan sponsor actually puts in the account for you to choose from. With an IRA, you can choose anything. There are a couple of dangers in having a limited set of options within a retirement account. The first is asset allocation. If you're limited on what you can choose, you obviously have less flexibility in how you actually allocate your assets and money within the account. And there's also expenses. If you have a small basket of investments to choose from, you may not have any options that are low cost. We gave an example at the beginning of the video about a $360,000 retirement account and how a 1% change in expenses would reduce the account value by $60,000 over 30 years. Expenses really matter, so being able to choose the funds you have in your retirement account is a pretty big deal. Additionally, there are contribution limits to IRAs, which we have on your screen now. Just keep that in mind as you prioritize how you arrange your dollars each year for retirement. And number 5 on our list are 401ks, 403bs, and thrift savings plans. Now, while these account types have 3 very unique names, they're really governed by the same section of the tax code, making their treatment very similar. So similar, in fact, that we've decided to lump them together at number 5. Now, all 3 of these plans, 401ks, 403bs, and thrift savings plans, are available in a Roth or traditional option, meaning your contributions can be on a tax-deferred or tax-free basis, depending on how you want to arrange that. They also will generally have access to low-cost funds and a sufficient enough variety of investments for you to actually arrange your retirement account as you like, and they still offer a place for tax-advantaged savings. Finally, the contribution limits in 401ks, 403bs, and thrift savings plans are much higher than in IRAs. Now, generally, we recommend that you save 15 to 25% of your income each year in a tax-advantaged retirement account. If you haven't reached that target yet, these higher contribution limits will hopefully give you a place to finish that off. If not, number 6 on our list is taxable accounts. Now, you might wonder why I'm listing taxable accounts with tax-advantaged options. After all, once you make a contribution to a taxable investment account, the contribution receives no tax benefit, and any earnings you receive are taxed. So you may wonder, is there any real benefit to using a taxable investment account? Well, the answer is yes, and here's why. In a taxable investment account, any earnings on assets that are held for more than a year are taxed as long-term capital gains, which are lower than income tax rates. Long-term capital gains rates are 0, 15, and 20%. We've actually got those brackets on your screen now. And regardless of what income tax bracket you fall into, the corresponding long-term capital gains rate will always be lower. So for example, let's say in 2024 your taxable income is $500,000 and you're in the 35% tax bracket. Well, that income level also puts you in the 15% long-term capital gains bracket. That means you save 20% in taxes on any earnings you realize from the sale of an asset within the account. Additionally, taxable investment accounts provide a lot of great options for converting money, moving money around as you approach retirement age, so you can be as efficient as possible from a tax standpoint. All right, so we said from the outset that we can't give specific advice through this post, but what I can do is kind of share what we do in our family. Our savings goal is 15% each year in tax-advantaged retirement accounts. We each have access to a 401k plan where we work where there is an employer match, so that's what we do first. We contribute up to that maximum amount each year. We also have access to an HSA, the annual contribution limit. This year when I'm recording it is $8,300. We contribute actually up to that amount. My employer actually does some as well. After the HSA, we don't have access to a 457, and we can't contribute directly to an IRA because of our income. Also, a backdoor Roth IRA is out of the question because of the pro rata rule. We have a pretty significant traditional IRA balance that would trigger a pretty high tax bill if we tried to do that. So we go back to our 401k plans and contribute without an employer match up to our 15% target every year. Now for us personally, after we've contributed 15% to tax advantage retirement accounts, we go to the taxable investment account with anything extra where it can grow. So hopefully you've already given some thought to where you save and invest for retirement. And if not, I hope this serves as kind of a roadmap for you. If you found this video helpful, please click like and subscribe so I can continue making content that helps folks learn about personal finance. As always, we're grateful for your time and interest in our video. God bless and take care.